Hi, and welcome back to this set of presentations on the simple economics of foreign exchange and exchange rates. In the last presentation, we explained what an exchange rate was. The fact that it's simply the price of one currency in terms of another currency, say the price of an Australian dollar in terms of euro, the amount of euro you have to give up to buy one Australian dollar. In this presentation, we're going to start looking at where those prices, the price of $1 in terms of euro, where that price comes from. And to do that, we have to ask why people are interested in buying Australian dollars and why people are interested in selling Australian dollars. Let's start off by thinking about why people might want to buy Australian dollars. Well, one reason is that an overseas company might want to buy some Australian goods. So, for example, a Chinese iron smelter might want to buy iron ore from Australia. To do that, it has to change some renminbi, the Chinese currency, into Australian dollars to be able to buy the Australian ore off the Australian mine. Another reason is that someone from overseas might want to buy some Australian services. So, for example, somebody from India might want to attend an Australian university. They need to pay the fees to buy the education services from the university in Australia, and to do that they have to get some Australian dollars. They would have to sell Indian rupees to buy Australian dollars to pay for their tuition. Whenever somebody from overseas wants to buy some Australian goods or services, they need to buy the Australian dollars in order to buy the goods and services. And of course, whenever somebody from overseas buys an Australian good or service, that means it is an export from Australia. So exports are the first source of demand for Australian dollars. A second source of demand is what we call income receipts. What does this mean? Well, imagine your grandmother living in, say, Germany, wants to send you a birthday present. Your grandmother would have to sell euro, buy Australian dollars to send you a birthday present that you would actually find useful. Of course, if she sent you euro, you would have to sell the euro and buy Australian dollars before you could spend them in Australia. So that income to an Australian is a demand for Australian dollars. What else comes under income receipts? Well, another part is if Australians own shares in overseas companies. The shares pay dividends, and they pay dividends in their home currency. So the Australians bring back that foreign currency to Australia and will sell the foreign currency, buy Australian dollars, so that they can spend their dividend income in Australia. A third reason why people would buy Australian dollars is if they want to invest in Australia. So, for example, if a Japanese company wants to buy a share in, say, an Australian mine, they would have to sell yen, buy Australian dollars, to buy the shares off the current shareholders. So foreign investment in Australia is another source of demand for Australian dollars. And in fact, all demand for Australian dollars can be categorised into one of these three groups: either exports of goods and services, income receipts for Australia, or foreign investment in Australia. Well, if we now look at why people would sell Australian dollars, unsurprisingly, we get an equivalent three categorisations. So some people would sell or supply Australian dollars because they want to buy goods or services from overseas. If an Australian wants to buy a Mercedes-Benz, they need to sell Australian dollars, get the euro to get the Mercedes-Benz. So that's what we call imports. Imports into Australia mean that we must supply Australian dollars to get the local currency to buy the import products. Income payments are another source of supply of Australian dollars. If overseas shareholders own shares in Australian companies and the Australian company pays a dividend, then they will get the Australian dollars They will sell the Australian dollars to buy their local currency so that they can buy the things that they want in their home country. And thirdly, foreign investment by Australia. If an Australian company decides to buy an overseas company, well, they have to buy the local shares, they need to get the foreign currency, and that means they have to supply Australian dollars. And again, all supply of Australian dollars can be categorised into one of these three groupings here. Now we know why people might buy or sell Australian dollars, demand or supply Australian dollars. We can start looking at the market for Australian dollars, or the foreign exchange market. From that, we can start working out the equilibrium price or equilibrium exchange rate. But before we do that, we're going to talk about some definitions. The current account, the balance of trade, and the capital account, because they fall out of what we've already done. But that's for next time. Looking at the foreign exchange market, that's in 2 videos' time. Talk to you then.